This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with our experts Manus Clancy and Diane Crocker. For the week of October 7th to the 11th, the 10-year Treasury rose above 4% as investors digested new inflation and jobs data. Consumer prices came in warmer than expected, and initial jobless claims spiked last week, driven by storms and a strike. Manus, on the heels of last week's surprise September jobs report, do you think the Fed has buyer's remorse on that jumbo September rate cut?
I think they must. I think at this point, looking back, I think you would call this ill-advised. Certainly, it was beneficial and well received by the commercial real estate market. Anybody who's used floating rate debt in the past will get a benefit. We saw a nice uptick in activity. So that is a real silver lining, but it does seem quite ill-advised and premature. Since the cut, we've seen a much better than expected jobs number for sure. 244,000 print that we saw last week, well above expectations. We saw that slightly hotter than expected CPI number today. And since the Fed announcement, the yield on the 10-year has done nothing but march higher. It was about 375 before the Fed announcement, give or take, maybe between 370 and 380, let's call it. And as of 20 minutes ago, I think we're at 4.11%, which is certainly not the direction that borrowers want to see the 10-year Treasury go, and is certainly not the direction that would whet people's appetites to deploy capital. So I do think that perhaps they succumbed to some of the pressure that was coming in. We saw a lot of business leaders pushing for a larger cut. Money managers said that we were starting to see the consumer get tapped out. Retailers were certainly saying that as well. And then several politicians, Elizabeth Warren and others, coming out, even calling for a 75 basis point cut. So all in all, there's probably some buyer's remorse, like you said, Martha. And I do think back on this and say it was probably an overreaction.
I want to call out somebody that we've talked about on this podcast before, Manus, and that is Strip Mall Guy. He's one of my favorites in social media because I just love his posts for their simplicity. And after the 10-year Treasury soared, when the jobs report that you just talked about blew past expectations, he comes out and he posts, "Here's further proof that nobody knows." And it just shows the numbers are all over the board. And you can forecast all you want, but sometimes things happen unexpectedly. We'll see what happens, but I'm not talking to anybody who thinks that after the jobs report that we're going to see another 50 basis point cut in November. And some people are actually now forecasting that the rates might not change after the November meeting.
The Strip Mall Guy had a similar tenor post sometime in the last 2 weeks where he said, anybody who says they know, right, or people who really say things with such assertion are the ones you can assuredly believe the least, right? The smart money, the smart analysts, the smart market watchers are the ones who really know that the data is messy. We're not really sure. And by the way, that extends to meteorologists. In the last 2 weeks,
Totally.
We saw what should have been historically kind of a non-event just completely pummel Tennessee, South Carolina, North Carolina, parts of Georgia. And, we saw this Milton, thank goodness that it became a category 3 and didn't come out as what some people were calling a category 6. We're lucky, right? In those cases, going back to the economy, we see jobs numbers that are constantly revised. So even though I've been critical in these first 5 minutes about the Fed and their ill-advised 50 basis point cut, I do have some sympathy for the fact that they're looking at messy data and they're trying to juggle things that are not always that easy to see. So I do have some sympathy but for those that come out and say that they know what's going on and what should happen and so forth, that's nonsense.
Yeah, I agree. I mean, you can forecast all you want. Sometimes the forecasters are right. I mean, here in New England, sometimes I stock up on toilet paper and milk and we don't get a single snowflake. And then other times I don't stock up and we get snowed in. But since the Fed cut rates in think it was September 17th or so. I mean, like you said, it's amazing. These two major hurricanes hit. We had unrest in the Middle East that started raising concerns about upward pressure on oil prices, which of course could increase inflation. Thankfully, it was brief, the port strike that threatened the supply chain disruption, and that's not really over. I mean, they still have disputes to resolve, but they got a grace period until mid-January. And these are all, I mean, each one individually is a major anomaly. And we saw one after the other in a very, very short time frame. And I think each one rattled the market in a different way.
The bottom line is we came into September with a lot of optimism. We thought rate cuts were coming. They did come. We were really pleasantly surprised and encouraged by that really steady lowering of the 10-year Treasury yield, the 5-year Treasury yield, the 2-year Treasury yield, all just really marching lower day after day. And that led to a significant amount of enthusiasm, I think not just among the three of us, but across the broader commercial real estate market. And now with the 10-year back at that 4.10% level, I think it's taken a little bit of the wind out of the sails for people like me who have been really believing that Q4 was going to be a really, really robust quarter.
I'm afraid to ask what's going to happen next in our news cycle. I'll take a couple quiet weeks personally.
I agree with you there. It's nice to just sit back, watch a little playoff baseball, for example, like with those Mets. How about that? And last night the Yankees too, right? I'm more of a Met guy than a Yankee guy, but I look forward to days with not a lot of hurricane coverage, strike coverage, economic turmoil, increased fighting in the Middle East. I'm looking forward to some of the more happier moments in life.
I did want to point out one positive out of the CPI number, and that was that shelter costs are finally starting to cool off a bit. And we've been talking about that for months. It's a third of the overall CPI number. So it's something that is important to watch. And we've been talking about how it's been elevated month after month. And finally, we're starting to see some relief there. So maybe it'll take some time for that to play out over the next few months.
It's such a wonky number that it's so hard to get your arms around that, right? They talk about this housing equivalent rent. So anytime I see this, it's almost like I don't have enough gray matter to get my arms around it, right? I'm thinking, well, yes, a leveling off or a cooling off of the rental component or the housing component of CPI, in theory, is a great thing, right? We want to see people's housing costs lower or level off. We want to see housing become more affordable. But then you get into that second derivative of what is causing this. Is this because we're now reaching a plateau on housing prices where they're not accelerating as much as they were in 2022 and 2023, and the lagging data is now finally reflecting that? Or is it truly a measure that on the multifamily side, all this inventory that has come to market in the last 12 months is finally making a dent, right? Is it starting to mean that people are not seeing really sizable rent increases year over year? I don't know the answer to this. I wish I had more gray matter. Maybe more fish would help. I don't know. Some of that, that fish oil that they say, or maybe Prevagen, right? You see that thing which helps memory. I don't know. Maybe one of those things would help considerably. But when it gets into housing and CPI, that's where I run into a wall.
And we were talking about the hurricanes. The 1-2 punch to the southeast is something that is going to take some time to play out in terms of understanding what the real financial loss is there. But we had a team of analysts do some work to look at Milton specifically as it was approaching Florida and do some analysis around what it might look like given the path of the storm, the properties and assets that are in the path of the storm, and what the level of damage might look like. Manus, why don't you give us a high-level review of that analysis?
Yes, our team led by Zach Wade, who's really the voice of research in our environmental natural hazard, I should say, part of the stuff. He's always tracking this and finding alternative data sources and so forth. A real nice asset in the LightBox community here. He put together a great visual which showed a lot of key findings about what he was anticipating. I know he's working on an update of this. We're now talking Thursday afternoon, so we're about 24 hours post when the hurricane made land in Tampa on that Wednesday. His numbers there were 500,000 structures at risk, primarily along that Bradenton, Sarasota, Tampa, Dunedin corridor along the West Coast. That represented a storm surge of only 1 foot, right? And people were saying that we could get 4 to 8 to 12 feet yesterday. I'm not sure what the final numbers came in, but even with only a 1 foot surge would have put 500,000 structures at risk. His numbers with a modest storm surge was at 85 billion. I know that others have put out numbers out there as large as 250 billion if the storm surge did hit 12 feet. So there's a lot to follow here. Before I get into the, another level of the analysis, let me pause for a minute, let you, Diane, and Martha get your thoughts in, a hot take on what's happened in the last 24 hours.
Well, I'll tell you, Manus, I don't know about you and Martha. I was glued to CNN last night watching Anderson Cooper cling to a palm tree and guys standing in these flooded waterways having a hard time keeping their balance. And I had a flashback to some work that we did with past hurricanes. In addition to the things that you just mentioned, we're about to hear a lot in the coming weeks and months about the price tag associated with the damage to both residential properties and commercial real estate properties from these two major storms, Milton and Helene. And, what you don't hear as much about are the environmental impacts that happen after hurricanes. In addition to property damage from winds and flooding, there are environmental risks from disrupting hazardous waste storage sites. And I've worked in the past on environmental impact statements with my LightBox EDR colleague, Richard White. And we worked on compiling lists of facilities that we have in our databases that are known to store hazardous materials or sites with known contamination, sites that are undergoing state cleanup efforts. And we did that after hurricanes like Katrina, like Harvey, like Florence, that were all near these major petrochemical complexes. So when I think about Milton and Milton's path across Florida, there are hundreds of manufacturers that store hazardous materials. There are power plants in Tampa that have coal ash ponds. There are rubber and plastic manufacturers that use hazardous substances in their processes. And, the risk is real. Studies show that there are 2 to 3 times more pollution releases after hurricanes in the Gulf than during normal weather conditions. So it's really critical for officials who are going to be busy in these coming weeks and months doing post-storm assessment work to know where in the cone of impact hazardous substances and contamination are located, just as the first step in assessing any risks related to pollution.
And if you're looking for any more data on this, Diane is the person to reach out to, a real expert in this field. We have enormous quantities of data on past events and so forth. LightBox has enormous amounts of information on this. So for those that are interested, please reach out to us. Turning our attention very quickly to the economic side of things. In the past, we found these types of events to be non-events from a credit perspective largely, right? When Katrina hit, nobody really knew how big the losses would be to lenders on properties. As it turned out, it wasn't terrible. In most cases, insurance covered the damage that was done. Borrowers were able to continue paying their rent. Properties were reestablished. And even though the economic damage to businesses was enormous and the human impact was sizable, for banks, CMBS lenders, and so forth, it was modest. I do think that will be the case here in Tampa. Again, if I were to guess, largely because they've been through this before. People do have insurance for big events like this. What I do worry about is more Helene, which impacted areas which normally don't have the kind of flood insurance that a place like New Orleans and Tampa have. That may be a different outcome for a place like Asheville or Augusta, Georgia, perhaps, which was very hard hit. Those areas may have a different outcome in terms of the credit impact than we saw in other events, which were kind of more expected. So I don't know if you have any thoughts on that, Diane or Martha. That's my hot take 24 hours after Tampa.
Yeah, I think numbers have come out about Western North Carolina. I think it was 0.5% of homeowners had flood insurance in that area compared to a coastal county like Dare that had about 43% of people that had flood insurance. So to that point, there's a lot of underinsured people that are going to be impacted in that region. It's not just for people who aren't insured. For people who are insured, that their insurance rates are going to be increasing, and that's a risk for owners as they're looking to close deals. Properties that may not be as profitable as they were, your insurance rates are certainly not going to be less than they were before.
I agree. And I think that there's so many layers to this particular onion. When you get into Western North Carolina, there was no expectation. That's why so few people had that flood insurance. You touched upon that. It is an area that is hard to rebuild. The roads are rural. Many of them were built 40, 50, 60 years ago. To give people a visualization of this, picture Lombard Street in San Francisco, but on a mountain, right? Roads that are weaving in and out of trees and up the mountain. When those things get washed away, it's very hard to rebuild those things. And that will have an impact. And for people that had hotels in the mountains or businesses in the mountains and so forth, while you can rebuild the structure, if people can't get their establishment, there's that business loss, which really insurance never fully covers. You've lost your clientele that will pick somewhere else to go. And accordingly, I feel, a real sense of heartbreak for those people in that area that I think the slog that they're facing is quite long. I do want to give an attaboy, though, to our team at LightBox. It just kind of underscores the type of people that I found in my short period of time working for LightBox. I mentioned this at an internal meeting a couple of days ago. One of the first reactions from senior leadership in our organization was, let's write a nice check to the American Red Cross earmarked for the area. Let's do what we can to help this area rebuild. And, I know a lot of companies do this. I know that there are a lot of companies that are socially active and try to do the right thing over and over and over again, but it's never not worth mentioning when it happens that when people do this, especially because it was happening on a weekend and people are busy and so forth, for our senior leadership to make this effort, I think was great. And the more that do it, the better. So thank you to everybody.
And we're about to release a survey that we did with a number of our clients and others in the community about PFAS, known as forever chemicals, for those of you that aren't familiar with that. Diane, why don't you walk us through very quickly what the PFAS survey is telling us?
For those who don't know what it is, it's an environmental risk. The regulations are still catching up with the science, and it leaves the commercial real estate industry kind of scratching their heads. How much of a risk is it? How do I roll this into our traditional environmental due diligence? If PFAS is on a property I want to invest in, what do I do about it? So we've been conducting industry surveys of environmental due diligence consultants for 2 years, just as a way to kind of measure how the commercial real estate industry is responding as awareness about the risk. So our results are coming out in the next week. I just wanted to share a couple findings here. One was on a scale from 1 to 5, 5 being very interested. We asked consultants how interested their commercial real estate investor and lender clients were in hearing about PFAS risk. And on a scale from 1 to 5, the answer was 2.66. I expect that number will only get higher as awareness grows. And then secondly, asked if PFAS conditions had any impact on commercial real estate deals. 30.4% said yes. That was a little bit higher than I expected. Others did say not yet, but it's coming. And I'll just add, Martha, for any of our listeners who are not familiar with PFAS, I suggest you watch the movie with Mark Ruffalo. It's called Dark Waters, but I will warn you that if you watch it, you may never fry an egg in a nonstick pan again.
That is true. I did see that movie, and it does freak you out.
Mm-hmm.
I think for the last 30 or 40 years that people that buy retail properties have become very accustomed to looking for where was there a dry cleaner in the past, because dry cleaners were notorious for putting chemicals in the ground. And I think some buyers early on in the process, I think most people know about the issue now, had incredible amounts of buyer's remorse or learned the hard way that cleanup for this can be very expensive if you don't do a lot of due diligence up front. If you're not boring holes and checking the soil and finding out what is in that ground. And now I think what you're talking about is something of a similar line, but on a much bigger level, right? There's only so many dry cleaners in every neighborhood, and it's not so hard to figure out where they were or where they are. With the PFAS stuff, it's going to be a lot more complicated. And I do think that 5 years from now, we're going to find some people that are writing big checks that didn't know soon enough that, this is stuff that has to be studied and looked for and so forth. And it's a problem that's growing very, very quickly.
In the past year or so, the only PFAS stories that I would see were in environmental news. And it's only been very recently that now the Wall Street Journal is covering it. There was an article this week in Commercial Observer. So I think those are signs that the commercial real estate industry is starting to pay more attention to it and realizing that just like due diligence related to dry cleaners, it's going to be important to find out whether they're dealing with the potential for PFAS risk. And at any rate, you want to know before you put your money down. And you may still move ahead with the deal, but it's always better to go in with your eyes wide open.
I was a big fan of the omelet station at those brunches where you'd go there and the guy would flip the omelet up in the air and it would all close upon itself, and your sausage and spinach and Swiss cheese would be right in the middle there. And that guy had to be using PFAS, right? That you can't pull that off, that flip, without a PFAS frying pan. And goodness, the number of those that I've consumed over the years is just alarming. They might have to bore a hole in me, see what's in there.
That sounds very scary. And now our LightBox data dive. Last week, we talked about our CRE activity index, and we're now releasing our market snapshot reports. The first one is the appraisal index for Q3. Diane, what did that look like?
The appraisal index for the third quarter had its third consecutive quarter of increases. And although Q3's was relatively modest compared to Q2, it was a lot more significant year on year. So that wasn't that surprising. Quantitatively, the LightBox appraisal index was 67.1 in the third quarter, and that was an increase of 3.2 points above the prior quarter, but it was well above 58.3 1 year ago. So that'll be in our first Q3 snapshot report for the appraisal sector, which is coming out next week.
And our Did You Know stat. Data from our Q3 appraisal snapshot report highlights how price and time competitive appraisal work is especially in a still slow market.
The average appraisal fee per lender project decreased slightly to $3,185 in Q3. Compared to Q2, but it rose nearly 5% compared to $3,044 1 year ago. And then the average turnaround time, you have to feel for commercial appraisers who are under really significant pressure to do their work very quickly. And the turnaround time on appraisal projects continues to tighten. It averaged 13.3 days in the third quarter compared to 14 in Q2 and 13.8 days 1 year ago. So they're hustling to keep their clients happy and doing their work as quickly as possible.
Okay, now who's leasing? We had a number of good stories across a number of locations.
The really nice one today, which I loved, this came from The Real Deal's Lois Weiss. She is somebody we followed for a long time. She used to write for the New York Post. She was reporting this morning that Google had renewed 300,000 square feet at 85 10th Avenue, a great sign of strength, a vote of confidence, and an encouraging sign for the New York market. That particular building, 85 10th Avenue, backs a several $100 million CMBS loan. That CMBS loan backs a single asset deal. There's both senior debt on there and substantial mezzanine debt. 5 years ago, we never saw single asset trophy properties go into default. We've now seen several of those in Los Angeles, in San Francisco, in New York over the last 2 years as offices are deemed obsolete, as people downsize And so when we see something like this, it's not out of the question that something like this could go into default if Google doesn't renew that lease. In fact, KBRA over the summer had downgraded some bonds on the concern for bonds that are backed by this particular office. So I love this story. It tethers with another one in Southern California that just last week, Google renewed 200,000 square feet of office space in Irvine. One of the narratives from 2022 to 2024 was those magnificent seven tech firms retrenching. Amazon, Google, Facebook, Microsoft giving up hundreds of thousands of square feet of space hand over fist over the last couple of years. Now we're seeing a reversal of that trend, and it's great to see. Moving on to a couple of other things I loved. Some are not quite as positive as others, but here goes. In Cincinnati at the Great American Tower, the largest tenant there renewed its lease for, I think it was 600,000 square feet to keep their headquarters in downtown Cincy. That's a great headline there. Another headline, this one we saw from, I believe, Commercial Observer. LA office leasing hits a post-pandemic high, up 27% from a year ago. In Irvine again, SiriusXM signed a 60,000 square foot lease renewal. That's at the Freeport Business Center. In Midtown Manhattan, Weaver and Tidwell signed a 37,000 square foot office lease expansion. I think they're quadrupling their space in Midtown Manhattan. And then the ones that are a little bit of a womp-wah in Washington, D.C., Arent Fox Schiff, a big D.C. law firm, has taken on 120,000 square feet in D.C. The good news there is that they are backfilling space that Fannie Mae has pulled out of. So that's the positive side of the story. The negative side of the story is they're downsizing by 43%, reducing from 210K to about 120K. Lastly, in Portland, we have Perkins Coie, the law firm renewed in the Pearl District. That's the positive sign there. The negative sign from that story is they too reducing their footprint by about 50%. So I would call it more good than bad in the leasing space. Some really big leases. Happy to report them. I do think that office leasing is picking up. We're not going gangbusters, but it is coming off the mat, so to speak. It's starting to inch up, and that's a good sign.
Turning to sales, we have so many sales and so little time, Manus. We're going to have to possibly do a speed round of some of these. Let's start with multifamily. You have a bunch in there.
We do have a bunch in there. The thing that I thought was very interesting here is just the diversity of properties and locations that we saw, the high prices being paid, but also the breadth of buyers out there and sellers. So we have a market that's really operating very efficiently right now. So here are some of the properties. The Quay at Wellington, Florida, $144,400,000 a square foot, up 20% from the 2018 sale price. The buyer there, Dermott. The seller, Stockbridge. Maitland Point, $100 million, $255,000 per unit. The buyer there, Journey Capital. Edge at Flagler, $100 million. This bought by Cardone Capital, the big syndicator. Trevito Rio Apartments, $77 million, $370K per unit, up 16% from the 2019 sale price. Sagard Realty, the buyer there. So a lot going on, a lot of buyers in the market, a lot of activity. Certainly the market segment, multifamily, is where we're seeing the highest level of velocity, things trading every single week with big numbers.
Manus, what's interesting is the Sagard transaction that you mentioned in Tempe. There's a buyer that typically focuses on industrial, and here they are buying a multifamily property, keeping that on their crosshairs. And John Bazuska, their vice president of acquisition, said that he's specifically looking for mid-rise and garden-style apartments in markets that have strong demographic growth, business climates, lifestyle and amenities, and the Sun Belt is in their target region. And for them, Tempe certainly fits the bill. So it's always interesting to hear stories like that, where folks are kind of shifting gears from one asset class into another if the demographics make sense.
Each of these jumps out at me for a certain reason, and I'll try to articulate this. First of all, in land, saw two big land sales last week. In Sunnyvale, a $100 million purchase by Applied Materials. This was an interesting one for me. The property only houses a Fry's electronics store, which I've never seen one of. I think they're big in the West Coast. It sounds like, Nobody Beats the Wiz, if you remember them, or some of those other, big, electronics. PC Richard is another big one in New York. Applied Materials is buying this. They're trying to assemble. They're making an assemblage. That's the word we use in CRE, of as many acres as they can in Sunnyvale to build a new foundry for the types of chips that they need in that area, and paying a huge premium for this particular property, $100 million, buying it from a gentleman named Robert Wise. Also in California, this is more traditional in Morgan Hill, the Crosswinds planned community, which is going to be a 269 unit housing development. KB Home brought that property for $76 million. The seller there, Dividend Homes. Turning our attention to something we don't talk about a whole lot, but I thought this was really quite something. In Cerritos, California, an extra space storage property was sold for $91 million. I can't ever remember a self-storage property selling for anywhere near that kind of price. Not sometimes you see portfolios of properties selling for that much. A single property in Cerritos selling for $91 million, which represented $37,000 per unit. Another thing, which I don't think I've ever seen, normally you talk about self-storage selling $15K a unit, maybe a low-end one is $10K per unit, a nicer one, $20K per unit, $37K per unit, just blows my mind. The seller there, Capital 360 and Bearing, so good on them for premium price. And then I'll close with two offices, which just go to show that sometimes not all the narrative is negative. Here in Santa Monica, the Arboretum Gateway, which is the headquarters of Universal Music, sold for $185 million. That represents $820 a square foot. The buyer there, Drawbridge Realty, the seller, Clarion Partners. It goes to show that the right property with the right amenities, with the right tenant on a long-term lease, paying a fair price, properties like that will get a solid bid. And in this case, that bid was $185 million. And then to close our very California-centric sales portion, the Highlands Corporate Center in San Diego sold for $77 million. This is a 5-building office campus. It sold for $350 a square foot. The buyers there, Harbor Associates and F&F Capital, and that comes from The Real Deal. That property, 90% leased. So a lot of good stuff going on this week outside of war in the Middle East, 2 hurricanes, hotter than expected CPI. If you get beyond that, we get to things like some good CRE activity and the Mets moving on to the semifinals in MLB.
Go Mets. So, Vanis, I can't believe when you were talking about that Applied Materials deal for that Fry's property, the seller's family is none other than the director of The Sound of Music.
I did see that. It is
cool trivia.
It is. I did see that now that you mention it, and I can't believe I didn't fold that into my notes today. I do love that movie. Ever since I saw it, I've been, dying to make some lederhosen for myself out of curtains, right? And just, just get out there and just kind of show my true self with the suspenders and everything else. Like, come on, like I'm not getting any younger. Like time is running out. Get the curtains down. Get the scissors, make some lederhosen, and just, get out there and sing.
Harmonize. Yeah, the other thing I wanted to note was one of your stories, the one in San Diego, the Highlands Corporate Center, the Harbor Associates, Justin Loicono, and if I mispronounce that, I apologize. His comment was that there's been a reset on office pricing and it's offered some investment opportunities in high barrier to entry markets. So I thought that was a really interesting comment that he made after that deal.
There's no shortage right now of people willing to buy office properties at the right price. We've seen it in even the most beat up markets of Chicago, San Francisco, Los Angeles. We saw Union Bank Plaza sell the other day for $80 million. It does seem like in Los Angeles, now we've seen 5 or 6 of these sales, and the prices are very similar. It goes between about $115 a square foot and $150 a square foot. People see the value of the location. They see the value of the physical plant, and at the right price, these things are trading. And I don't think this is going to be like malls where some people came in, bought for 20 or 30 million, and then a couple of years later, like the Namdars or the Cohans would then sell it for 20 million. Like there wasn't a whole lot of upside. I do think that the people that are buying offices, whether it's for conversion or for amenitizing, will make good returns here. I think it's something that's going to happen, and people will be happy that they leaned in 2024.
The flywheel is starting to spin, and if the numbers work out, then it looks attractive and they're going to ink deals. And I think these early kind of movers are going to incentivize others to do the same, especially on properties like the one that you just talked about with Harbor Associates. You said that's Class A office space and it's 90% leased, which is a terrific stat in today's market.
And to close out, the company that brought us an immersive Monopoly game to London and Dungeons and Dragons to New York has leased 50,000 square feet in Times Square. They haven't said what they're going to do exactly, so they're keeping a little bit of a secret. It would be kind of cool if it was Clue, in my opinion, because I think that would be interesting. I don't know. What do you think?
I'm already picturing them looking for a little bald guy with a mustache to stand out on the sidewalk in a tuxedo, luring people in. This takes me back to my childhood big time.
I was always a low-end board game guy. I wanted to end in 5 or 10 minutes so I could go out and play baseball with my buddies. Monopoly was way too lengthy for me, or Risk, or some of these other things. I needed something like Candyland. And that would be my dream. The thought of getting a card that takes you to the top of this thing, or maybe it's Chutes and Ladders, I'm thinking. Maybe I'm getting two games mixed up. But being at the top of this big slide, sliding down into a mountain of candy corn or a mountain of lollipops, like, take me back to being age 7, right? Like, that sounds like my immersive thing. Go to the top, get in one of these windy slides, and at the very end, you come into a mountain of Hershey's Kisses or something like that. So some kind of mashup between Chutes and Ladders and Candyland. That's my dream for that 50,000 square foot parcel.
I'm hoping it's Clue. Colonel Mustard in the conservatory with the candlestick.
And I meander so much on these podcasts that you may find Martha sneaking up behind me with the candlestick one of these days to get me to stop talking. I don't know.
And with that, we'll close. Thanks to our producer, Josh Bruning. Please join us every week as our LightBox team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send your comments or questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.
Mets.